Hi guys, Brindley Little here, coming to you for your next instalment of 100 in 100. This is instalment number 37, working our way through the full development appraisal stage of the process, and we're moving on to funding in this session. Now, prior to securing the deal, obviously you've got to balance balance your plates between spinning plates between securing a viable deal and obviously raising the required funds to actually purchase and set up the funds to for the subsequent process. So it's a bit of a chicken and egg situation. But we would always suggest that you are actively out there looking for both. And when it comes to raising finance from maybe private investors for maybe the equity that you're putting into deals, then it's about keeping them continually informed in terms of what you're doing on a maybe daily, weekly basis, on a regular basis anyway, in terms of your acquisition activity. Using previous projects is also a good way of demonstrating competence and experience and credibility, which obviously is key to raising the required funds. But when it comes to the appraisal process, you get to a stage where, well, we don't know exactly how much we're going to need at this stage, because obviously we may have worked on some costs, some high level numbers. We're adding detail to the costs as we go through, and what we find is some developers can spend an inordinate amount of time and concentration on working out real fine details, such as what development finance rates, interest rates are on offer at the moment, what are the in fees, arrangement fees, what are the exit fees, and changing them on maybe a daily or a weekly basis, almost depending on when you're going through your appraisal. We simplify the process when it comes to funding during the appraisal. Obviously, the funding aspect during appraisal, what we're actually looking to kind of achieve really is realistic costs of finance. Now, there's determining factors to realistic costs. It's not just the interest rates that we're looking at. We are looking closely at timescales as well of the development, because we can spend a lot of time looking at different interest rates and work out, how much it might cost to lend 250,000 or £500,000 or £1 million to purchase a piece of land, and then the subsequent development lending for the build. But if we don't estimate the timescales effectively, then you could find yourselves in a situation where you are being penalized very, very heavily. You've got finance on increased rates that effectively erodes profit. So it's really key to make sure that you've got realistic time scales, realistic costs in terms of the build, and obviously we're going for a residual valuation method, so we'll have a good handle that if we've got our costs realistic, then we're going to come up with a appropriate land value, because essentially it's about satisfying lender requirements. Now, the money that you're going to need, 100% of the project funding that you're going to need, called the capital stack, made up of three different parts, or can be made up of three different parts of funding. It's often made up of two, but it can be made up of three. First being your senior debt, which is your main source of funding, your main development funding that takes first charge, usually from a bank or development finance company. Typical rates, when you're taking into consideration all of the fees and everything like that, interest rates and fees, you're probably looking at a range of 5 to 15%, depending on where you're going for that. You've got equity, which is obviously the skin in the game. It might be your money, a combination of yours, maybe investors on fixed rate loans, or investors that are coming part of a joint venture, as it were, and invested in the profitability of the project. And then you've got a bit in the middle. If there's still some missing, then you've got mezzanine finance, which is usually provided by a specialist lender at much higher rates. Usually, you're probably typically looking at anything from 15 to 25%. And that just stretches the equity effectively. It plugs the gap between the equity and the senior debt. So if your senior debt's perhaps raising or lending 65% loan to value, or maybe they're lending up to 80% of cost, or whatever the requirements are from that piece. If you say got 10% of equity and you need to plug that gap, then you need to possibly go to a specialist mezzanine lender, or maybe even speak to another investor to increase that equity stake. The equity piece is obviously the profit. There can be a coupon rate as well, so an interest rate added to the equity. If you're, say, lending from a private investor and you want to provide them with a fixed rate return plus maybe a part of the profit, so that the fixed rate return would be a coupon rate, which that can range from anything relatively small, maybe 6%, something like that, or lower to potentially maybe 10-12%. But that depends, in terms of the investors that you're dealing with, and whether their appetite for risk and things like that. That makes up 100% of the capital stack. And at an appraisal stage, we essentially work on a blended rate. So we work on a blended rate of finance, rather than working out how much equity we're going to need, how much debt we're going to need, if we need mezzanine finance, where it's going to come from, what rates we're going to be paying. We put it all into what's called a blended rate, and we basically use at an early stage. Remember, this is in the appraisal. We're building on this all the time. So once we've got to a stage where we're further down the acquisition process, we'll be then detailing much more, creating much more detailed cash flows and things like that. But we typically work on a 10% per annum interest rate for blended finance. So that's across the board. But one of the things that you need to consider when looking at your finance costs is that you're not going to be using 100% of that facility for the entire duration of the project, for example. So a pretty simple example, if your facility is, let's say it's 1.25 million, so 1.25 million, and it's 250,000 for the purchase and £1 million for the development costs. You're not going to need 1.25 million from day one, effectively, because obviously development finance is paid on a measure, on valuation, as and when you go through the project at different stages from the development finance point of view. It also depends on how you've structured the deal, in terms of how much money or equity you may need to purchase the land, for example. In a straightforward scenario, you might be paying 250,000 for the land, for example, and you might be paying that all up front, in which case you are going to need the 250,000 plus some costs, plus a bit of a buffer in there as well. So if you're £1 million build and 250,000 for the land, then you don't just require 1.25 million. You're probably going to require more, because you need that cash buffer. Your contractors are going to be happy to see a cash buffer there as well, which is important when going out for tender and pricing and things like that. So in this instance, you'd be borrowing 250,000 for 100% of the project duration. So we apply what's called a burn rate, and a burn rate is how fast you are spending the money. So in that example, 250,000, it's 100% burn rate, because we need the money for 100% of the entire project duration. So if it was 10% per annum interest on 50,000, and let's say the project was 12 months, just to make it easy, then we know that our finance costs are going to be in and around the region of £25,000 per year, or £25,000 in total if the project is a year, for buying land. Now, if we needed £1 million, and that's obviously going to be paid in stages throughout the process, so we won't be paying 10% on on a million all the way through. So at an early appraisal stage, we apply a 50% burn rate to the build, so the development finance. So what that basically means is, in terms of a calculation, that's just based on the straight line cash flow at this stage. Obviously, we'll work out more detailed cash flows, but basically what that means is that we the calculation within our own spreadsheets is that it's 100% of the money, so £1 million for 50% of the time, so £1 million for 6 months at 10% per annum, or it's 50% of the money, so 500,000 for 12 months, so the entire duration. And the calculation works out the same, 10% per annum, so we know what we're going to be paying on that piece as well. So a blended rate just allows you, certainly 10% per annum blended rate, allows you to get a good idea and fairly realistic expectation in terms of what the finance is going to cost you, and obviously helps in terms of working out your residual valuation and then moving that forward into things like the deal structure. If you're applying a 10% per annum interest rate on the land, for example, and you set up your deal structure in such a way that they don't require 250,000 all up front, they might be happy to structure the deal where they get 50,000 and they get paid 200,000 at the end of practical completion or something like that. Then potentially there you can then add whatever that cost would have been on your finance, and possibly put that into the landowner's pocket as well, provided that you structure the deal correctly and legally. But effectively, during the appraisal stage, putting robust appraisals together is the key to raising finance. It's key to raising finance from investors. It's also key to raising finance from your main funders as well. So it's about satisfying the lender, and what the lender is obviously looking for as well during this stage is your experience and your team's experience. So if you as a lead developer don't have the sufficient experience because you're fairly new to the game, then it's imperative that you put an experienced team and you have experienced consultants around you, and you can highlight the fact that you have this experienced team around you to deliver a successful project. The first couple of projects are always the most difficult to raise finance for newer developers, until you establish your own track record, and then it opens up avenues to different lenders and different avenues of finance, because effectively you as a company and your experience, your team's experience, will dictate where you get the funding and what terms your funding is likely to be on. Effectively, more inexperienced people highlight probably a bit more risk to the lender, in which case then you may only be able to go to a certain number of lenders and the rates may be higher. So it really does pay to have experience in and around you to save on things like finance costs where you can. Now, not satisfying the lender during the appraisal stage prior to exchange is one of the biggest reasons that commercial deals fall out of bed, which obviously opens up opportunities to things that you may have seen in your local area that have sold subject to contract, for example, if they're on the market, or you may think that, or you may have spoken to landowners directly and they're already in agreement with somebody else, for example. It's always worth keeping tabs on things like that and going back to them in a few months' time just to see if they've made any progress, because if the deals do fall out of bed and you can come back in, then there may be some more motivation there from a seller's point of view. So hopefully you found that interesting. As I said, as we go through the appraisal, once we've secured a viable deal, and then we're looking at more detailed cash flows, then we'd be changing these figures. But at this stage, what we do not want to do is undercook the costs, both from the build side and the fees and the development cost side, and also the finance side as well. So that's kind of an insight into how we go about treating funding during the appraisal stage. And we'll be joining you again for another installment of 100 in 100 coming soon. And we'll be finishing off the full development appraisal part of the appraisal process, and then moving on to securing deals. So hope you found that useful, and I will see you again soon. Thanks very much.